Hi, and welcome back to FANG Friday. I'm Ross Healy, Chairman of Strategic Analysis Corporation and Portfolio Manager at McNichol & Associates Asset Management. This week, a couple of critical changes are in sharp focus on our SVA radar, and you need to be aware of them now. In addition, we're going to take a look at Microsoft, which is also at a critical juncture. So let's get started with the most intriguing potential signal of all, Netflix. The first and most critical stock that we're going to look at among the FANGs is Netflix. And look at this. On the announcement of its earnings, the stock price has fallen to its HB4 price, that is 20 times book value, and in late trading today, it's actually fallen through that level. The HB4 price is 323. The stock has now fallen below that as we come to a close during the day. Why is this occurring? Well, it doesn't take a genius to figure that out. Look at what's happening to Netflix subscriber growth. It's falling off a cliff. In the US, the numbers are turning negative. Internationally, they're slowing down very, very considerably. And of course, as we know, they have already lost one key series, Friends, and they're about to lose another, The Office. How serious is this for the stock price? Well, let's go and take a look at the long history of this company. And let me point out that you do not have to have a bear market for the shares of Netflix to do horribly badly. Look at what happened in 2011. The stock fell some 65%, and I think actually was down close to 80% by the end of the total movement. Going back to 2004, we weren't in a bear market then. We were in the full swing of a bull market, and the stock still fell 60% during that period. So just because we're not in a bear market now, or at least it does not appear to be one, doesn't mean that those numbers could do a lot of dirt to the price of Netflix. Be very, very careful, particularly now as it looks as if the HB4 price is not holding. On the other hand, if we want to be a little bit on the positive side, look at Nvidia. Nvidia had been trying to break out over its HB1 price, that's 10 times its book value, and indeed for the last 5 days has been holding successfully at and above that price of $166, $167. Now, I'm not a complete unmitigated bull, and I'm not forecasting now that the stock is broken out for sure for two reasons. The first one is I have not seen their most recent quarterly earnings. And as we have seen with Netflix a moment or so ago, you get some ugly earnings and pretty awful things can happen to the stock price. The other thing is, of course, coupled with the earnings, I get an updated balance sheet. And we're uncertain as to where that balance sheet may well be in this quarter. So the break point at $166.70 may or may not be accurate, and I would really love to see that balance sheet and the earnings to confirm the breakout. However, if you want to anticipate, then be my guest. Amazon, of course, simply continues to soldier cheerfully along, riding its 30% balance sheet improving chart, and earnings are coming along quite nicely. Facebook, the same thing. We have a buy hold on Facebook, and it continues to hold above its mid super growth price. That's 5.5 times book value. On the other hand, Alphabet, we still haven't seen the decline to the super growth price. That's 3.5 times book value. That is typically where stocks will tend, growth stocks like Alphabet will tend to bottom. We haven't seen it as of yet. and we are quite inclined to wait for it. And Apple, the same thing. Here, rather than showing you the short-term chart, what I've done is shown you the chart of the past 10 years. And what is a standout here is the fact that Apple typically has peaked at or a little bit shy of its fair market value. Now, it did go slightly above it just very, very recently before that decline into December of 2018. It's had a nice rally, but it's back to its bubble price. That's 7.4 times book value, but it also is its fair market value. And the fair market value, by the way, you can see from this chart very slightly, is slipping a bit. The first quarter was pretty awful for this stock. Let's see what the second quarter brings. But I would be very careful about this stock, and we have not changed it from its sell avoid. Anyway, that's the FANG stocks, but there is one more stock that merits, I think, a little bit of discussion right here now, and that's Microsoft. Well, Microsoft came in with some earnings that we would have to describe as real barn burners. However, the stock so far has refused to confirm that the market is all that bullish about the numbers. Yes, it popped back up again to its HB1 price, and that, by the way, was where the stock peaked last year at exactly the same level, but it has yet to break out. So we're not exactly from Missouri. Those are awfully nice numbers, but we haven't seen the confirmatory action from the market. And indeed, if we take a look at the long sweep of this company for the past 5 years, again, we'll see that the HB1 price has been pretty steady resistance to prices moving up any further. Perhaps it can. Those were good numbers, but we need to have the market confirming that bullishness. We're just not going to take those earnings as being self-evident. Well, in summary, it's not business as usual. Amazon and Facebook remain buy holds all right. And Alphabet and Apple remain sell avoids. But Netflix has gone critical, as it were, and maybe on the cusp of its own recurring black hole. Nvidia, in the meantime, seems to be struggling to give us a buy signal. And whether you act or not depends on your willingness to act on hope rather than hard data. As for Microsoft, I think it wants to go, but has not said so yet. Wait for it. I'm Ross Healy, Chairman of Strategic Analysis Corporation, reminding you that nothing, including investing, is difficult if you've got the right tools. See you next Friday for what could be a very interesting follow-up week.